The Nasdaq market is currently closed, and the last reported price for Rezolve AI PLC, ticker RZLV, was $298 at the close of trading on November 26, 2025, reflecting an intraday movement of minus 0.030 or a 1.00% decline. Now, the general expectation circulating in the retail space and even among some long-term holders is that Rezolve AI is an emerging artificial intelligence play caught in a classic post-SPAC de-risking phase. But the reality is far more complex and involves a highly active institutional hand that has been both buying the dip and facilitating large short positions. This is not simply a narrative stock trading on hope. The recent price movement, particularly the daily swings that saw the stock trade in a tight range between $2.93 and $3.06 on its last session with a volume of around 12.5 million shares, indicates heavy churn. This churning suggests a significant redistribution of shares, which is typical following large financing rounds or recent smaller acquisitions, both of which Rezolve AI has executed recently. The common ground assumption is that this small-cap stock is following the usual volatility pattern for high-growth, unprofitable tech companies, exacerbated by general macroeconomic pressures where investors are prioritizing near-term profitability over speculative growth. But a deeper look reveals that the stock's stability in the low $3 range, after having a 52-week high near $8.45 and a low near $1.07, is perhaps more noteworthy than the daily red tick. The general belief fails to account for the substantial institutional activity recently disclosed. We see filings showing major institutions like Alyeska Investment Group, Citadel Advisors, and BlackRock significantly establishing or increasing positions in the stock as of their most recent disclosures, with Citadel in particular showing a massive increase in its reported holdings. This move by sophisticated players suggests a belief that the risk-reward ratio at the current valuation, which sits well below analysts' price targets that average around $10.79, is attractive. This directly challenges the narrative of a stock simply being flushed out of the system. Instead, it looks like smart money is moving in aggressively to accumulate a position at these lower levels, using the selling pressure from retail and smaller funds as liquidity. The market is not just consolidating, it is being quietly re-engineered by large funds betting on a future catalyst. Let's look more closely at the recent stock movement. The stock has been under considerable pressure over the last month, registering a drop of over 38%. This dramatic slide, even with positive news flow, is often where the hand of short sellers becomes most visible. While the company has been announcing strategic moves, such as the acquisition of SmartPay and Subsquid, to build out its agentic commerce architecture, and the recruitment of senior executives from companies like Apple, Google, and Microsoft, the stock price reaction has been muted or even negative. This is the tension between expectation and reality playing out. The expectation is that good news drives the price up, but the reality of high dilution, continuous losses, and concentrated short selling can override fundamental developments in the short term. The substantial financing Rezolve AI received, which was reportedly around $200 million and involved some of the same institutional names now holding large positions, may have been necessary, but it inherently put downward pressure on the stock through a mix of warranties, convertible features, and the sheer volume of new shares issued or soon to be issued. The market has been pricing in the dilution that comes with securing this level of capital. Focusing on the core business, Rezolve AI PLC operates in the high-stakes world of artificial intelligence for the retail and e-commerce sectors. Their platform, built around the Brain Suite and its proprietary large language model BrainPower LLM, is designed to power what they term agentic commerce, essentially autonomous AI-driven shopping experiences that handle everything from personalized discovery to one-click checkout and even digital asset payment support through their recent acquisitions. Their model is subscription-based, targeting large enterprise customers with annual recurring revenue, or ARR, contracts. They have cited a $9.8 million annual deal with a major Mexican retailer, Liverpool, and boast an ARR figure that they project to accelerate significantly, aiming for a $500 million exit rate by the end of 2026. This is the expectation: a vertical-specific AI platform positioned in a high-growth sector with proven enterprise traction. The reality, however, remains that they are heavily unprofitable, with a negative shareholder equity and net income figures showing significant losses, which explains the high-risk categorization and the skepticism from a portion of the market. They are a land and expand growth story, where the market is currently fixated on the land cost rather than the expand potential. Now, let's address the short-selling dynamics, which are absolutely central to RZLV's recent price action and volatility. Short interest in Rezolve AI has been notably high. The most recent reporting shows short interest figures hovering around 12 million shares, which when compared to the average daily share volume results in a days-to-cover metric slightly above 1 day. While a days-to-cover figure around 1 is not indicative of an immediate explosive short squeeze, the consistent volume of shares being held short is a clear pressure point. For retail investors watching RZLV, the high short interest as a percentage of float, over 10%, tells you that a significant portion of the tradable shares are in the hands of short sellers. These short positions are held by major hedge funds, some of the same names that appear on the institutional ownership list, which is a classic and complex dynamic. The motive for firms like Citadel to hold massive long positions while also holding short positions is often attributed to hedging strategies or arbitrage related to convertible notes and warranties, rather than a direct bet on the company's failure. But a less generous interpretation from some corners of the retail community, particularly in discussions on platforms like Reddit, is that it represents coordinated pressure to keep the price suppressed to allow for cheaper accumulation of warranties. This debate between smart hedging and naked shorting is a constant feature in high short interest stocks. Investors need to pay close attention to the borrow rate for RZLV shares, as this is the cost short sellers pay to maintain their positions. Spikes in this rate are a direct signal of increasing demand to borrow shares, and therefore an indication of escalating short seller aggression or tightness in the supply of shares available to lend. The fails to deliver data, while generally low in the last month, showed significant spikes in September and late October, coinciding with moments of extreme price volatility and a large block of institutional activity, which is an area that often fuels retail skepticism about market transparency. The actionable step here for retail investors is simple. Routinely check the publicly available short interest data released semi-monthly, and couple that with monitoring the share borrow cost data from sources like Fintel. A sudden, sustained jump in the days-to-cover figure, perhaps moving consistently above 2 or 3 days, combined with a sharp rise in borrow rates, would be the primary signal of an escalating short squeeze risk. But for now, the short interest is a foundational downward pressure, not an imminent squeeze trigger. I'm curious, what's your take on the rising short interest in companies like Rezolve AI? Do you view it as smart money hedging or market manipulation designed to keep the price down? Comment below with your perspective and tell me if you monitor days to cover for your decisions. Looking ahead, the future outlook for Rezolve AI PLC is anchored entirely to execution. The company has essentially secured its runway with the recent financing, giving them a window to convert their lofty ARR targets into tangible, growing revenue that can chip away at their substantial operating losses. The next catalyst is the upcoming earnings report, expected in early December, which will provide the first real look at how much of the new capital has been deployed, and more importantly, whether the enterprise customer deployments are accelerating as management has promised. The expectation is that they will show aggressive spending on sales and marketing. The reality must be that this spending translates directly into significantly higher ARR figures, ideally beating their own internal targets to reverse the negative stock momentum. Risks include integration failure of the acquired assets, a slowdown in enterprise technology spending, or a failure to differentiate their proprietary LLM, brainpower, from larger, more generic AI platforms offered by tech behemoths. The opportunity lies in validating the agentic commerce vision, proving they can execute on their global expansion, and turning the current institutional accumulation into a base for the next sustained price increase. If the company hits their $500 million ARR target exit rate by 2026, the current valuation will look deeply discounted. The tension